US jobs data or non-farm payrolls on Friday in the wake of far higher than forecast private payrolls in the US economy on Wednesday, where we were expecting 190,000 and the number came in at 298,000. And the January reading was revised up as well. Where does this point us for Friday's release? Well, Chris Beauchamp is with us with some more on this. First of all, about the numbers we're expecting. 190,000, I think, is the forecast for Friday's number, on an average payroll number of, I think, 0.3% month on month, and also the unemployment rate to come back from 4.8 to 4.7%. Is there a correlation between the readings from ADP to non-farm payroll? Should we expect a higher reading on Friday?
Not a particularly strong one. If you look at history, sometimes it's a very good leading indicator. Other times it gets it way off. It's just the nature of the beast, the way ADP is a private company that does its own payroll forecast. This is Friday's numbers from, of course, the Bureau of Labour Statistics. But it does tend to be a useful prelude, if you like. And I think certainly today's number does set us up very strongly for a good non-farm payrolls number. And of course, really, the payroll number on Friday is not as important perhaps as the wage growth number. Certainly that's one piece of the puzzle in the US economy that's not been as strong as you would like. And of course, what does it mean for next week and that Fed meeting in March? Because suddenly March, almost out of the blue, is a live meeting. And the Fed has been saying, in fact, Janet Yellen herself said, all but said March is a go at this point. I think it'd have to be a shocking number on Friday, a big drop in numbers, a big increase in the unemployment rate, and a miserable number on those average hourly earnings to really say that March is suddenly off the table.
One can't imagine a situation where that's going to rise, especially with this ADP number and the way that jobs have gone up recently. Let me just quickly ask you another way to trade this, because I think it's important to point out that this is a number that can move all sorts of markets.
We will see, I think, the impact of non-farms across the board. You'll get the dollar, certainly the primary point to watch in the first instance, and then of course that has a bearing on US stock markets, on gold, on oil. Everything tends to feel non-farms at some point during Friday's session. So we want to look for what we might think would come to pass. If you get a good reading, the natural expectation would be that the US dollar continues to increase. In fact, it's increased after this ADP reading. It's shot higher. And you look at something like dollar yen, and you can see that we're steadily moving off the lows of the last couple of weeks, really, for dollar yen. And we're starting to push through this descending trend line. You can see there. That comes back from those January highs. The big rally in dollar yen stalled in January. It's pulled back about 600 points or so, and now maybe it's poised to break out, and perhaps another good non-farm payrolls number could provide the sort of background for that.
It's interesting actually going back to the stock markets, because if you get a good number, it looks like the economy is doing well, as we know it is in the States already, and of course a lot of Trump's suggested policies have pushed the equity markets up to record highs. If there is a very strong number, it almost, as you say, cements this idea of a higher interest rate next week. That potentially is negative for the stock markets.
It's only negative in some parts of the stock market. I think it's things like utilities, those big high-yielding stocks that people buy for the income. If we think interest rates are going to go higher, so borrowing costs will go up. So you might see a move out of things like electricity firms, water companies, that kind of thing in the States. But generally, as you say, it's an improving US economy. Things are getting a lot better. More jobs are being created. People have more money to spend. So it's a self-reinforcing cycle, which fundamentally is good for the stock market. And I think it's always good to try and dispel the idea that just because the Fed is gradually raising rates, it doesn't mean the market can't go higher in the longer term. Fundamentally, the outcome for the US economy is much better, and that should support the stock market.
OK, Chris, all right, thanks so much indeed. Just a quick reminder that IG will be live on the IG player on www.ig.com at 1:25 p.m. on Friday, just 5 minutes before the release at 1:30. I'll be speaking with Mike Ingram from BGC Partners. Hope you can join us too, 1:25 p.m. UK time on Friday.